there's still this, disbelief or confusion around how big an impact can this downgrade really have, because you have the likes of Jamie Dimon and Arian saying this is ridiculous and ill-timed, etc. But the market, the equity market, is saying something else.
Okay, so let's understand all the elements one by one. The Fitch impact, is this a reason for markets to blink or reverse? Now, that for me I think is the most important sheet or the most important data point. What has happened to the US bond market last night? The US bond market, or the 10-year yield now, is at 4.1, and the peak it made was actually not far away, which is it was at 4.3. Even though globally the construct of inflation is down, the US 10-year paper is moving higher, and the global volatility actually has shot up. The implications of that, I think, are visible in the way how the dollar index and other basic asset classes have moved. So if you turn it around and go beyond the 10-year asset or the 10-year paper, you actually would realize that in the world right now, the scare per se, I think, is not there, but markets surely have become slightly more tentative.
Okay, so slightly more tentative as far as the global setup is concerned, because as far as the cues from the last week are concerned as well, there was a bit of a slip that we saw yesterday. We were talking about how we were very, very range bound for most part of the 7 to 8 trading sessions. Yesterday we broke out of the range, but on the downside, because it was a very, very sharp fall that we were witnessing throughout the trading session yesterday. We slid almost 300 points at one point. However, by the end of the trading session, we managed to recover almost 100 points from the bottom. Having said that, all the sectoral indices were firmly in the red. The broader market outperformance completely reversed today. So the advance decline ratio was unfavorable. The broader markets underperformed. And India VIX, that spiked quite sharply yesterday. That was higher in double digit. And then Nikunj, the FI, selling also continues yesterday. No surprise, but then there was another sell figure of 1800 crores.
So Nisha, how should one read into yesterday's price action? Now, yesterday's price action I think needs to be connected with the global connect here. I don't think Indian markets will fall independently or Indian markets will fall in isolation. My sense is very clear that if at all the selling or reversal or the pause, it will be global in nature, it will not be local in nature. I continue to believe that globally things, at least in the US tech space, at least in the US, AI space, I think that is space where a correction is overdue. Now, since I expect the nature of the correction to be largely global in nature and largely tech in nature, I expect that the impact of that on India is just going to be sentimental, not so much so in terms of a real reversal. So Indian markets, if they fall, they are likely to fall less. But what may actually happen in the interim is that markets may hit a pause button, and you may actually see a little bit of reshuffle, and the hand-on-heart traders, they may be forced to cut their positions, and this global adjustment may lead to a very sharpish rally. So if you're a Nifty trader, yeah, we've gone below 19,500 yesterday, but I don't think there is reason to worry. If markets stabilize for a day or so, I think you should not expect too much of casualty. In this market, what the approach should be? The approach should be you should stick to banks, you should stick to domestic focus themes, and the big domestic focus theme in my book, I think, is urban consumption and hospitality. So for me, if you're looking for the new defensive would be hospitality and the entire urban consumption theme.
Okay, so hospitality, urban consumption, these are the things to watch out for. Having said that, what you were saying is also true in terms of the FI long short positioning from almost 70 to 30 in terms of long short 10 days ago. It's come down to 49:51. So they are net short now versus net long. So that also tells you that there's a sharp reversal in terms of the last 10 days, what has happened in terms of the market. But given the setup, what should be the strategy? Because we have been telling you that, weathers have changed. Of course, we were all talking about that summer rara rally earlier. That is not the case anymore. It's monsoons now, and the strategy also has to change. It's the start of a fresh new month, August, and we have seen already 5 consecutive months of gain happen. And history tells us that when there is 5 months of gain, the next month is very, very somber. So in setup of all of this, Nikunj, what do you think should be the right strategy right now?
I would say wait and watch. Don't buy the fall right now.
Okay.
Avoid commodity consumers, because if there is a real fear which is centered around inflation and crude prices moving higher, electricity prices moving higher, coffee prices moving higher, copper prices moving higher, inflation and the China connection in the second half of this year could pleasantly disappoint, which actually could be a bummer. And then if you are really looking at themes, I guess where you have got tailwind right now, it is hospitality, it is urban consumption, select defense name, and companies which are related to capital goods stocks. So while I don't expect too much of collateral damage, but I think it's too early to buy the fall. One should avoid buying into commodity consumers, and the defensive is not IT, the defensive is not pharma. For me, the defensive is urban consumption and hospitality.